Friday, October 6th, 2023, Menaco 64, home of alternative economics and contrarian views. So today we've got something a little different. We've got Clive Thompson back on. Clive, nice to see you again. How are you?
Good morning, Mario, and very well, thank you. Nice to see you again.
Yeah, Clive, I've heard yourself describe yourself as a retired doctor, so to speak, that likes to come and see his patients even after he's retired. So yeah, I think you're one of the favorite guests here on the channel. So you're like a financial doctor, and I always find it enlightening to hear what you have to say. And today, why don't we start with the fact that U.S. debt to GDP could go to 766.9% of GDP, which seems crazy, but you found some data from the government themselves, from the Congressional Budget Office. So if we could cover that first, and then we're going to look at what's happening as well in the bond markets and all the other sectors of the financial markets and also the economy, and then cover what you think about the non-farm number today. I know it's just a temporary short-term thing. Yeah, so yeah, I'll let you take over about this 766.9% debt to GDP.
Excellent. Well, the starting point, I think, for those people who aren't sufficiently familiar about the way the government works, the US government, along with most other governments, produce their budget. And in the US's case, they have a budget going out for the next 10 years and a projection which goes out way beyond that. Those projections are produced by the Congressional Budget Office, or the CBO, which is part of the US government. So when the government spends more than it collects in taxes, which has been historically the case most years, it has to borrow the difference, and that increases the amount of debt. Now, increasing the government debt isn't such a big problem if that debt doesn't increase faster than the GDP of the country, because if the taxes go up by 10% and the spending goes up by 10%, the debt should stay fairly constant as a percentage of GDP. But what can go wrong is when your deficit, your budget deficit, is sufficiently high that your debt is rising faster than the growth in the GDP. So what I'd like to do is just look at, first of all, if I can share a screen with you, Mary, I think you've enabled screen sharing. Look at the government's official, or this is not the government's official website, but it's their projection of where they think it's going to go. And then we'll move on to see what might happen, where we get this 763% from. Now, can you see the screen, Mario?
Yeah, I can see it.
So what you see here in the blue chart is going back to the 1940s, the level of debt as a percentage of GDP. So you see it did back after the Second World War, it's peaking out at about 100%. And then it went down, and it was mostly around 20 or 30%, and then more recently up to 60% in the early 2000s. And if you look here in 2023, that's the year which just finished on 30th of September, we're at 98 or 100% or debt to GDP. And then they have a projection which rises over time to, on this graph, by the way, this is the official projection, to 181% by 2053. Now, these projections do change over time. But what I wanted to look at is what I discovered on their website, because not only do they have the official projection, which is based on the official budget of the United States, but they also have they don't publish it anymore, an alternative projection based on a number of parameters. And I'm going to look at the alternative projection in number terms as they published in 2009. So in 2009, the debt to GDP ratio was 56.60%. And in the column in the middle, the one which is called debt to GDP ratio as forecast in 2009 baseline, or the official budget forecast, they saw that by the time we get to 2023, that's this year, the debt to GDP ratio would have risen from 56% to 57%. So over a decade, not much change in debt to GDP. That's a perfectly reasonable plan. You don't change your debt to GDP ratio much. Be good if it went down, and in some years they'd forecast it would go down. But the plan in 2009 was to keep the debt to GDP ratio fairly constant. And then they saw, as the population aged, the debt to GDP rising after that to, by 2033, to 74%, and going all the way out to 2083, which was quite a long way in the future, rising to 300%. But they also, in 2009, and I found this on their website, published what they called an alternative scenario, which, reading between the lines, is what I think they really thought would happen. And it's actually what did happen. So going back to 2009 on this chart, you see we had 56.6% debt to GDP ratio in 2009, which is a reasonable ratio. The Maastricht Treaty in Europe says that it shouldn't go above 60% debt to GDP ratio or you're in big trouble. What they said in the alternative scenario, instead of getting to 57%, in the alternative scenario, they said we'd get to 101%. Well, that's what's happened. We're as good as at 101%. We're at over 100% as we speak today. So the debt to GDP ratio has hit their alternative forecast. And if you look at the alternative forecast, as we stretch out through the years, in 10 years' time, it's going to be 164% debt to GDP instead of the 74 they'd previously forecast. And it goes forward to 766% in 2083. Now, I know most people are going to be well, many people will be dead long before we get there, and probably people are laughing at that. And I hope they're laughing because they think we'll never get there. And I can assure you we can't get there because it's mathematically impossible. Something is going to break long before.
Clive, could I just interject a little bit, second?
Yeah.
Some people might be asking, well, I thought the debt to GDP was like 123%. Well, that's the one that includes the debt held by the Federal Reserve. So that's why this is debt held by the public. But one thing I would say, Clive, about the Federal Reserve, they're supposed to be unwinding their balance sheet. So someone is going to have to buy all the debt that they sell as well. So I think that could increase even more, unless, of course, the Fed stops selling the treasuries that they have and also start buying it. And I think you wrote something on LinkedIn about this 766.9%. And I said, well, if we do get there, a tall latte at Starbucks will cost 10,000 American lira. Because that's how it used to be in Italy back in the 80s and 90s, 5,000 lira for this or that.
Yeah, so you're absolutely right. There's two debt to GDP ratios. One debt to GDP ratio is the debt owned by the public, and this is what I'm showing you, which is the important number. The other one is the debt to GDP when you take into account all the debt, including the debt owned by governmental agencies. And there's a little definition here if you want to look it up on the government website. I'm showing you very quickly on the shared screen what debt owned by the public includes a lot of things, and then intergovernmental debt is extra debt, which really basically owe it to themselves. But can I just move to an interesting chart here, which I put together myself? This is a chart of the debt to GDP ratio from 1962 to 2082, and we'll start by looking at the green line, which slopes upwards. So in other words, the debt to GDP ratio. We'll look at the red line, which is sloping upwards. So we start at 2009, right in the middle of the chart, and you'll see the red line slopes upwards, and that is their projection as made in 2009 as to what the debt to GDP ratio would be. The green line is what they called back in 2009 when they made this projection, the alternative projection. And that basically was a projection of what would happen if the government didn't go through with certain tax increases and so forth, which they didn't. Now, what actually happened? Well, the green line is the line we're actually on, not the red line, which they forecast in 2009. So if you look at there's now another line started, which is the blue line starting in 2023, which is the latest forecast. which is what the government says they will do, but they have not published an alternative forecast. So I think the alternative forecast that they maybe accidentally put out in 2009 still stands, and we might be seeing that debt to GDP ratio not following the blue line, but following the green line. That is a possibility, and certainly it could well happen if the government has the same sort of miss on their receipts and expenditure that they had in the previous decade. So it could be very serious. And if we get there, as you say, 10,000 lira, American lira, for a cup of coffee is where we're going to get to.
Yeah, and Clive, you kind of wonder if they have an alternative forecast, but they're not publishing it, and it could be even steeper than the old alternative.
Well, Mary, they do have it, but they're not publishing it. But if you read the commentary on the Congressional Budget website, they make a variety of comments about alternative scenarios along the lines of what if they don't reduce taxes, what if they don't increase taxes, what if they don't reduce expenditure, what if this, what if the pension funds in the United States don't go bankrupt, as they're going to, as will happen in the next decade or so, because they have to assume, whether it's right or wrong, but they have to, by law, assume that the payments from the government pension funds to the pensioners will continue even after there's no money left in the pot. Because what's been happening, they've got a fund, people have been contributing, and that fund has a certain amount, it has a certain liabilities. The Americans have got the right to receive their pension. But by the time we get to 2033, the biggest one, the pot will be empty.
Yeah.
So they won't be able to pay people's pensions in full, but they have to assume that those pensions will be paid in full, but not by the government, but by a fund which has got no money. So if you factor that in, that adds, $500 billion a year to borrowing requirement from the government to fund that. That's one example. There's many, many other examples.
Yeah. And I noticed, I think it was Zero Hedge originally a few days ago, they noticed that the U.S. national debt or public debt increased from 31 trillion, I think it was at the time, I don't know what it was now, 31 trillion, 50 billion. And the next day it went up to 31 trillion, like 433 billion. So it increased by 275 billion in one day, which is very worrying. Hopefully, the pace of increase in the debt, some people are now saying it's $1 trillion a month. Hopefully that won't continue. But if it does, I can see why the bond markets are in trouble. And we spoke on August 22nd, and I'm just going to repeat what you said here because I quoted you. You said orderly queue to leave smoky cinema could turn into a stampede. And you were talking about the treasury market. So maybe you could talk about what's going on now with the treasury market, what you think about that increase in the national debt a few days ago, and whether, I don't know if you look at the reverse repo, that's dropping a lot. I think that recently dropped by 300 billion. And in the reverse repo, for the viewers, that's the when the Fed sells government securities to the banks, and they put the money with the Fed for overnight, and they keep doing that. So it's kind of weird that that reverse repo decreased by 300 billion and the national debt increased by 275 billion. Do you think that's related?
So I hope you can see my screen again, Mario.
Yeah, we can.
To share that. It's showing the yield on the US 10-year Treasury. So just to refresh the memory of those, or the minds of those people who don't really understand it, as yields rise, the price of the bond falls. That's basically how it works. So bond prices across the board are falling, and the longer the maturity, the more they've fallen. So the 10-year bond price has been falling, or put it another way, which is where the thing which everybody looks at, the yield has been rising. So when we spoke a month ago, the yield was somewhere between 4% and 4.5%. And you can see it's now, that's from this morning, it's 4.74. So it's been rising fairly sharply. And the reason it's rising so sharply is because the US government has a large borrowing need, and that's coming from three different things. First of all, the government is spending 2 trillion a year, very roughly, more than it collects in taxes. So it has to borrow to fund the difference. That's called the budget deficit. So that's 2 trillion a year. The Federal Reserve, which is doing quantitative tightening, is allowing some of its bonds to run off and be repaid by the government without reinvesting the money. So it's not, so they're reinvesting part of the money which matures, but they are letting some of it be repaid by the government. That's called quantitative tightening. That's accounting for about 1 trillion a year borrowing by the US government. And last but not least, the US government has to refinance all its maturing debt and the interest on that maturing debt. So every year it's got a lot of debt maturing. I don't have the figure, but I'm guessing it's about 5 trillion a year needs to be refinanced. So we're talking about 2 plus 1, 3 plus 5, 8 trillion a year of debt perhaps being refinanced. And the public at large are basically saying, well, that last bond which matured was only paying 2%, but I'm not going to reinvest my money at 2% anymore. I want a much higher rate, because when I look at those numbers from the US government as to how you're going to keep borrowing from Peter to pay Paul and how you're going to repay me, you're going to borrow from somebody else, it looks pretty dire. So people are saying, I want a higher interest rate to reward me for lending you money. So people are reluctant to lend. The government of Japan is reducing its holdings of US treasuries. The government of China is doing so. And I imagine countless individuals and funds around the world are thinking along the same lines. So unless those yields go higher on the newly issued bonds, people aren't going to be investing in the US treasuries. So I think that's the problem with the bond market right now, and that those factors are not going to go away. So even though the current expectation is that Jerome Powell will keep interest rates on hold for the time being and probably sometime middle of next year, maybe reduce them. That's the expectation. I heard it on CNBC and Bloomberg this morning. It doesn't mean to say that the Federal Reserve has any control over bonds. They have a control over the short end, the overnight money market rate, which they can change to whatever they like. But if they're going to control the bonds, the bond prices or the bond yields, they'd have to go in and start buying bonds. And that would be a complete flip from quantitative tightening to quantitative easing. Now, if that happens, and at the moment, the Federal Reserve is not making any signs or signals whatsoever that it's going to go in for this, which is called, this is another word for this is yield curve control, when you start to buy bonds to adjust the yield on the bonds. If they start doing that, the whole world will see it at once, and people will realize that we've gone back into this quantitative easing phase. What's quantitative easing? It's when the Federal Reserve prints money to buy government bonds, because the government's, in other words, to lend money to the government. And when they start printing money again, that's, of course, all bets are off for everything, because the money is being pumped into the economy and there's more money around, so asset prices go up. And we could, on that day, when it happens, unless the market's anticipated ahead of time, we could on that day see a complete melt up in all kinds of assets. And that would certainly include gold and the stock market and things. You just to sort of illustrate it, there was an incident back in 1934, on the 31st of January 1934, where the government did something a little bit similar, but effectively what they did was reduce the value of the dollar by around, it's close to 50% on one day. And what happened? The stock market soared, as did the gold price. The gold price was up 50-60%. The way they did that actually was to increase the price of gold, which meant that from $22 to $35. But it was in terms of the principal thing, it was the same thing, because what they were doing was creating a lot of money in one go. So what happens when the Federal Reserve buys government bonds? They're printing money, creating a lot of money in one go. I see that as a possibility down the line.
Clive, you spoke about how China, Japan, and some other countries are decreasing their holdings of treasuries, and I've seen charts on Twitter, people posting that, but others countering that that's only going down because the value of their holdings have gone down. Do you know whether those numbers are published of the par value and whether they're really selling them, or if they're just being revalued lower? I mean, because some people will argue that, and some people are arguing that the Fed is doing this on purpose in order to keep, which sounds weird because at the same time the market is selling off, is in order to keep China and other like enemies from selling treasuries, but at the same time it's resulting in the sell-off of treasuries, and it seems to me that most people don't understand. They just look at the average person out there watching even CNBC or Bloomberg. They only want to know about the stock market, and they neglect the bond market, even though I think the bond market is just as big as the stock market. And it's really what determines the rate of discount rate for valuing stocks. So maybe you could talk about that, and why do you think stocks are still performing really well? Is it because maybe bonds are going to rebound, or maybe we could see something more sinister and a big crash, for example, in the stock market?
A lot of things in there. Let's start with the Japanese bond market. Yields have been rising because the Japanese government had been engaging in what's called yield curve control, something that the US government is not currently doing. So what was happening, the Central Bank of Japan, the Bank of Japan, BOJ, was buying 10-year bonds and other bonds along the yield curve to keep the yield well below 0.5%. So it was about 0.2%, and then it was gradually increased to 0.5%. A month or two ago, they announced they were going to modify that and allow yields to float a little bit more freely, but they wouldn't let it go above 1%. And almost every day since then, we've seen the yield on the 10-year Japanese government bond increase a little. So it's now moved above, it took a few days to move above 50, then it went to 55, 60. It's now, I think it's 80 bips, 0.8% on the JGB. So your first point is, the first point to make on that is that the yield on Japanese government bonds has gone from 0.2 to 0.8, so it's 4 times what it was. And some people in Japan will find that more acceptable than as an investment than the 0.2 they could have got. And I read an interesting article saying that in Japan, finances are managed by the housewives. Husband goes to work, hands the money to his wife, and she does the investing. And reading the article, suddenly it sounds like housewives are pretty financially astute and engaging in all sorts of things I wouldn't even be able to do myself, like such as currency hedging and so forth. But what had been happening was that housewives investing their husband's money had been buying up American bonds because they could get a higher yield on American bonds. Back then, we're calling it maybe 1.5%, 2.5%, compared with 0.2 or 0 on the Japanese bonds. So what's happened is the dollar has gone up a lot, Japanese yen has gone down a lot, and the yield on Japanese bonds has quadrupled to 0.8. I can imagine that some housewives are starting to say, I've got a capital gain on the dollars, albeit that maybe they've lost money on the treasury, but you can think it whichever way you like. But I can now bring some money home and invest in what's now an acceptable yield to be at 0.8 in government bonds. But there is another side to the story, and that's the exchange rate. There's a lot of talk about what would happen if the Japanese exchange rate went through 150. That's 150 yen to the US dollar. And the way a central bank or the government would stop that going above 150, how the Japanese would do it, would be to sell their US treasuries and buy yen. Simple as that. So I think it's quite plausible that money is coming out of the US Treasury market and back into the Japanese government bond market. I think it's from domestic investors. I don't think international investors are at all attracted to a 0.8% yield when the inflation rate in Japan is well above 2. I think it might be above 3. So yeah, I don't think it's international investors. I think it's domestic investors and maybe the central bank and maybe the government who are buying up the Japanese government or bring the money, buying Japanese yen by selling treasuries.
Yeah, and I think as well, in terms of the yen, is that like you said, inflation in Japan, I think, is more like over 3%. And the excuse of the Bank of Japan is that if they didn't keep policy as loose as it is right now, it would drop below 2, but it is above 3. So I think it shows that they're in such big trouble. And the Bank of Japan, they own a lot of these JGBs. I think they own over half of all JGBs issued, but it seems like they're losing control, in my opinion. And so I wanted to ask you now.
Well, you had another question about stocks, Mario, which I
Oh
didn't
yeah. Oh
answer
yeah.
yet.
Oh yeah. That's right. Yeah. Maybe
Um,
you could answer that. I forgot.
so the question is why? I mean, the stock market has gone down a little bit in the last few weeks, but the question I think a lot of people are asking is why is there a big crash? Because if you read the economics books, it says interest rates go up, 10-year bond goes up, stocks should go down. But that's not really been happening. We've had a year or two of stocks of bond yields going up, a year of bond yields going up, and stocks have not really fallen; they've risen. So why is that? Well, I think a lot of people are saying, first of all, the yield on bonds is not enough to compensate me for the inflation risk as I see it now. I know the official inflation rate is in America, what's it? I haven't got it exactly, 3% or 3.5%, 4%. But a lot of people feel that that might go up again. But in any case, it doesn't really reflect the inflation rate as reflected by the quantum of wealth being created through the printing of money and treasury bonds. So at the moment we're increasing the debt, that's a share of wealth which is going to the hands of the rich, of course. So people are saying, I want to keep pace with the inflation rate, and one of the ways to keep pace with inflation, I mean, we have many others, of course, is to own tangible assets, and companies own tangible assets because they have real estate, they have goods, raw materials, and of course they have intangibles such as their supply chain, their workforce, their goodwill, and their brand name. So people see this as a way to keep pace with inflation. Yes, you're not getting the sort of yield anymore that you were getting. So you probably got a 2%, 2.5% yield on stocks, but at least that's a 2.5 or 3% yield, which is going to rise as the GDP of the country rises. And I think a lot of people are just saying, what's the alternative? Do I take my money out of stocks and put it into cash? Well, you're a bit on a hiding to nothing there. You might earn 5% at the moment, but what if something does go wrong with the bond market and you suddenly find you can't spend your cash? People can see, and if we talk about the bond market, it's even more dire. I want you to imagine a scenario. You have a friend and he's maxed out all his credit cards, which is what the United States have done. And he comes to you and says, can you lend me some money? And you say, fine, show me your books, income and expenditure. And so he shows you, and you see that he's spending about 50% more than he gets as a salary. So you say, you don't sound like a very good bet. How are you going to go bust soon? How are you going to repay me? He says, oh, that's all right. I'll borrow from somebody else, and I'll give you 5% a year for the next 10 years. Well, I don't think I'd be willing to lend that friend money. At least I might give it to him, but I wouldn't expect to get it back. That would be my comment. So, of course, the US government is not my friend, because my friend cannot print money, and the US government can via the Federal Reserve if the Federal Reserve plays ball, and I'm sure they will. So what's going to happen? Unlike my friend who's just going to default, the US government isn't going to default. That won't happen. But what they will do is resort to the printing press. And so it's like my friend saying, yes, I'll pay you back, but I'll pay you back in Italian lira or some defunct currency by the time you pay back, or monopoly money. It's the same thing with the United States. They're going to pay me back in dollars. There's no doubt about that. But when they do pay me back in dollars, it's going to be worth a lot less, because there'll be a lot more of them out there, because they've been forced into the situation of printing it. Because as we saw about that debt to GDP ratio, you cannot, it's impossible for any country to keep increasing its debt relative to GDP ad infinitum. There comes a point where something breaks and people say, I'm not going to get my money back. And I think we're getting close to that.
Yeah.
So That's why people are in the stock market and gold. I mean, I think gold will have its day. It's not having its day at the moment because gold is behaving negatively to the higher interest rates because it increases the cost of carry. But at some point, when people see something breaking, maybe the Federal Reserve moving from QT to QE, I think that's the day when we see a 5 or 10% leap in the price of gold in one day, and then upwards from there.
Yeah, and what you said about lending money at 5% to someone who's, up to here and that, I agree. And the other thing as well, with the U.S. economy, and what I wanted to say is that we're not trying to say this is just happening in the U.S., but it's happening here in the UK and other EU countries. But the reason the U.S. is in much deeper trouble, I think, is kind of it's like it's because of this Triffin paradox where you have the reserve currency and it gives you this power to just print and borrow and be able to buy things from everywhere around the world and not to have to accumulate reserves of other countries. And I think that's what's kind of made the United States kind of complacent about the debt. And I think very few people understand it. And so turning back to the stock market and the bond market and the fact that we have non-farm payrolls today, which is an important number, and wanted to ask you your opinion on that and the economy. I heard now that on Bloomberg or CNBC, they're talking that people on Wall Street now want the stock market to crash so that the bond market recovers. Is it possible that this time around, because of all the debt and the fact that the economy is slowing down and that the government is spending so much, that we could see if the stock market to crash, yeah, maybe bonds will rebound for a day or two, but eventually I personally think they could even crash too. And that would be that would raise alarm bells. Just want your opinion on that.
Obviously, if we have robust figures, it means that interest rates at the short end, from the Federal Reserve's point of view, can keep going up. And the stock market is not going to like that. The bond market isn't going to like that because it will signal that possibly we're not going to stay on hold and then go down. It possibly signals we're going to stay on hold and then go up in interest rates. So if those, I don't know if the figures are out yet. I haven't seen them anyway. But if they're robust, that means a good number and showing that lots of people have got jobs. Then it shouldn't be very good for the stock market. But this is these things are daily noise, and every day of the year we get some bit of news which is positive, negative, and you can't base your entire investing strategy on what comes out from one day to the next. So my long-term view is you should balance your portfolio between various types of assets, of which the stock market and gold and property and other things should be different categories, and stick with it. You might tweak a little bit here or there depending on what you think is going to happen, but if you shift too much in one direction, and someone wrote to me yesterday saying that they think the stock market will crash, so they're 97% in cash. Well, I had to reply and said, I think you're taking a very dangerous bet. You put 97% of your money into one asset class, and you might be wrong. Let's look at what happened in 1994. 1994, we had a very similar situation to what we have today. Stocks have been rising by double digits for some years. We had interest rates very much on the up, and all the newspapers saying stocks are overvalued. Well, what then happened? We went on and saw another 6 years of one of the greatest bull markets in all of history. And those who'd exited because they thought things were overvalued, and I want to say I don't think they're overvalued, my assessment, but those who thought they were overvalued then and exited are still waiting for their day. And the Dow, by the way, just to say that at the time the Dow was about 10,000. Now it's what, I don't know, 30,000 or 25,000. I don't even look at the Dow anymore. But it's certainly, they've missed out on a great bull market over the last 25 years, 30 years nearly.
Yeah, I remember it was the bond market that had a mini crash in 94, but then I think it rebounded. So yeah, I mean, from what I hear from you is that for people who are concerned, diversification, and it depends, of course, on the individual. They might want to hold more gold, more silver, But yeah, what about counterparty risk? Are you concerned about the system and that something could happen and they could, we've seen, I don't know if you've seen in the UK, there's a small bank that is in trouble, Metro Bank.
Metro.
Yeah. Do you worry sometimes about stockbrokers or, not being able to going under and oh yeah, the other thing as well, there's a lot of results next week. I think Friday the 13th, JP Morgan's results are coming out, and there's a lot of speculation that we're going to see balance sheets of banks be in really deep trouble.
On your last point, yes, I think we'll see balance sheets of banks in trouble. Obviously not all banks, but there will be some for sure. On Metro Bank, well, your deposits are insured up to £85,000 by the government. So no worries if you have less than that. And I think the government in the UK has got a habit of paying out very quickly. I say that I haven't ever seen and had an experience, but I think that's the situation. So probably if you have a deposit with Metro Bank and it fails, you'll get paid out very quickly. Right now, they're talking to other banks to try and sell part of their mortgage book. Why do they want to sell part of their mortgage book? Because people are withdrawing their money, and as money withdraws, they need to get that money from somewhere, so they've got to sell something. So they're looking for two things. One, they're trying to sell part of their mortgage book to other banks, which they'll end up selling at a certain discount, which means they'll be making a loss and booking a loss. So at the same time as doing that, they want to raise some new capital, and they're trying to raise £600 million, I believe. Whether they can get that money or not, I don't know, but it might end up that they've got to be merged into another bank. And I've no doubt the powers that would be the Bank of England or whoever's in looking at this, I can't remember who's looking at it, but anyway, whoever will be looking at it, they'll be trying to persuade some of the big banks to take them over. And the reason people banked with Metro Bank, I believe they offered quite a high interest rate, if I'm not mistaken. It was one of the most attractive interest rates. But anyway, no, for the private investor who's got money in the bank, no worry. But if you happen to be one of the equity holders, I think you've lost, as we speak, 97% of what you put in.
Yeah, and I think there are people who have business accounts with Metro Bank, and they might have more than the 85,000. So I personally would say, and this is not advice, I'd be concerned about that and maybe try to open another business account very quickly. So as we wrap up, Clive, have you got some final words for the viewers? Because it always seems that we're in a crisis or near a crisis, that things are breaking up and people get frustrated. So how do you handle or deal with it, not just financially, but psychologically?
Okay, well, there's a lot in there. First of all, I've got nothing to sell. I don't have any business. I'm a retired person, so I used to work in a bank, and of course, when you work in a bank, you're supposed to promote the bank's products. But I don't have to do any of that now. I can tell things exactly the way I see it, and I'm not saying I promoted the bank's product. I would only promote things which I saw as good. But right now, I'm an independent person, and so I'm not trying to sell any particular asset or product or anything else. I just tell people what they should be doing. And I get consulted quite often by individuals who have sold a house and don't know what to do, and I'll give them the advice completely for free. Those who want to see what I'm thinking at the moment, if you link up to me on LinkedIn, you can follow me. That's the correct way to do it. You follow me and you'll see that I publish articles once or twice or 3 times a week on what's going on in the world and what I think is happening. But the kind of things I'm following is what's likely to happen to the value of your money, which if you get the general gist, you should probably be investing in something other than cash most of the time. That might change if the economics of the world changes, but right now I don't think that cash or bonds are a particularly good bet. And we've been saying that for a long time, Mario, haven't we? And of course, I do write about gold and silver. I think those are attractive investments too. What else could I say? I think, Mario, stay diversified is the fundamental thing I say to everybody. Don't have all your eggs in one basket, because things don't always work out the way you expect, and certainly they don't work out the way I expect. Things do change, and that's why I have my lots of different baskets, and they do include cash, but it's quite small. But you have to have cash for rainy days, but you've got to have a variety of things, because things might be very different from what you hope or expect.
Yeah, so basically, yeah, and also don't panic, Mr. Mannering. I don't know if you remember that program.
Yeah, well, that's you've got to know you've got to know your own psychology. How do you, if you buy stocks, for example, or gold or whatever it held, Bitcoin or whatever it happens to be, and the price goes down, how are you going to feel? Are you going to say, "Oh God, I'm so stupid, I made a mistake. I should have, I would have, I ought to have," and panic at the worst point, or are you going to shrug your shoulders and say, "Hey, it is what it is. Who cares?" Now, that's what happens when you buy a house. When you buy a house, on day one, you've lost money because you must have paid the highest price that anyone was willing to pay for that house. Otherwise, someone else would have bought it. You've not only lost money, you've lost the stamp duty, maybe 5% or 10% or whatever it is in the UK, but certainly you've lost the stamp duty and the legal fees and everything else. And if you try to sell it the next day, there's no way you could sell it for the price you just paid. But it's not in your face. There's no stock market telling you your house has just gone down by 10% or 5%. So you don't care. You say, well, it's got a utility. I'm going to live in it. It doesn't matter. Well, the same thing, and that's the way I look at stocks. For example, if you buy a stock, it's paying its dividend. The share price might go down, but provided their business hasn't gone down, the dividend should go up every year. And just as the utility of your house goes up over time as you do decorations and improvements and so forth. So if you're the sort of person who worries when someone tells you the next day what you bought is worth less, probably volatile assets are not for you, or if you do have them, keep them to a small amount. But for safety reasons, I would say don't be in money assets or bonds. Be in the volatile assets like property, equities, gold, and anything else which you think will still have value after the currency reset, which we'll talk about on another day, I think, Mario.
Yeah, great, Clive. Thank you for your time again, and I wish you a very good weekend in Switzerland.
Great. Thank you very much, Mario. Have a lovely rest of your day.
Thank you.